Okay. Um, awesome. All right. So some of you might have been familiar with a lot of things I talked about, but other ones might have been very overwhelming. But the idea is again opening the gate for you to investigate more. With that in mind, does anyone need the slides, or should I leave it, or I can just leave it and then if you have any questions, let me. Anyone needs the slides, otherwise I bring everyone so we can see each other. So, any questions, any comments? Was it too much, too little?
Oh, that
Yes,
was good, Uncle. Thank you for that. Learned a lot about portfolio management from that. I had literally no clue, especially with correlation ratios and the betas and whatnot. That helped a bit.
oh, thank you, Ken. Yeah, that's very important because you have a long life ahead of you. You're going to build a portfolio, especially with children and other things. So, okay. Anyone else? Any other comments, question?
Yeah, this is Leonard. I can use the slides to use as a guide.
Yes, yes. And then we can go.
Thanks.
Thank you, Chief. Appreciate that. Richard?
Well, I mean, there's a lot of things, you pick up from CFA about the portfolio management stuff, but a lot of the, I guess, the hedging strategies that you brought up, really interested in looking into those even further. One of the questions I had was, you know, from the classroom to in practice, one of the things that, that gets discussed a lot, I feel with a lot of my students is the time window that you look at things. You had a correlation slide where you look back only 10 years in the classroom. I have some professors that would argue if you have more information, the better. Do you have like any like maybe comments on that, or like how would you approach maybe advising and how far back to look or when to look, like what time periods?
Absolutely. That's a great question, Richard. And we apply that actually in cycles, seasonalities, the same thing. Um, Richard, I also apply that for like sometimes you find advisors who've been in business, for instance, or companies, or you see even portfolio managers. We definitely like to have, uh, when it comes to correlations and seasonality, I like to have markets who have gone to recession or bear market and bull market, because things can get uh, you know pretty biased if we look at. I give you one example. If I look at from 2009 all the way to 2021, for instance, markets, you look at all the growth, large cap have done magnificently, and the small caps have done nothing. So if I use that as a criteria, which is 12 years, by the way, Apples of the world, and you look at Googles of the world, and you look at Amazons of the world, they've been the stars. Then you look at some of the energy stocks like Exxon and Chevron, well, they've gone nowhere. So for me personally, I look at, I like to have two bear markets, two bull markets, and I also like to see recession and obviously expansion. So I like to see the cycles, and that's a big factor for me. So one of the problems we have, Richard, in um, with the new economy, and unfortunately, it starts with central banks, and especially, well, they say Greenspan started after 2001, the recession, but specifically Bernanke after the financial crisis, the 2008 and 2009, the Fed has been very proactive in in changing the whole idea of how economy works. So with this easy money, it has become more of a manipulative. That means if I'm a child and I misbehave and I get rewarded for it, the whole psychology changes. So what happened? Yes, it saved the economy, and that's what the bottom line. But what happened? It became artificial cycles in a way. We used to have every 4 or 5 years, we used to have recessions, and it was like a clockwork. And what this recession is not bad thing. Recession gets rid of the overusage and the excesses. So we need that as again for the growth point of view. But when we have all these excesses and then the parent, and in this case, Fed gets involved, then you have artificial cycles. So going back to your question, I go back 50, 70, but for me, I like the 25 years. So I look at 25, 15, and 10. 10 is good because I go back to that recession. Every 5 years, we did have recession. So I use the 10 because you have two fives. But again, nowadays things are artificial. So I like to look at 25. That's a good number for me. But 10 is also not bad, but it's not as strong as, again, 25. The other problem is one of the things against the 25 is technology is growing so much that our economy is not the way it was in 25 years ago, for instance. But that's, I think that's, at least at this time is a little mute. We are not going 50 years ago, because some people use 75 years, 50 years, we use that. But you look at those companies, 1970s, you look at Polaroid and Kodak and Sears, they're not around. So we don't want to use that. But I would say for me, Richard, 25 is what I would do, but 10 is also good because generally there is the peaks and troughs in there. I just end this, but before it might be a funny thing. All these investment conferences you go, there could be money shows, all these newsletter writers or performers come in and they want to sell their subscription or whatever. It's like their services, or there's a mutual fund manager. There have been times that you look at, they come and what are they bragging about? They have all these things and they say, in last 1 month, our portfolio is up 10%. In the last 3 months, we're up 20%. So it is very impressive. And you look at for past year, they're down like 40%. Past 5 years, they're down like 80%. So it all depends how you really, but there's an old saying, that the numbers don't lie, but whatever, there's using the numbers, so the data is important, but how you choose it is important too. So is that helpful, Richard? It's a long answer, but
Yeah, no, that's helpful. Just working with students, sometimes they tend to pick the time frames or windows or whatever fits their narrative and the point that they're trying to make. And it's something that becomes more and more, how do I explain this to students who are learning about portfolio management? And I want to make sure that, I tend to tell them like, hey, like standardize it, make things consistent in the time periods that you're looking at, and don't look at like time periods just to confirm your thesis.
correct.
Right.
Excellent point.
And yeah, and like I always wondered what's like in practice what they do, because if you're to compare financial markets in the past compared to where it's at now, it's just things have exponentially changed. So even looking at like 25 years ago or like 50 years ago, like yeah, the times, like I don't know if it's even comparable.
No, that's exactly right. Yeah. So I mean, the 25, let me use 50. I just want to make sure there are two. We've had bear markets and we've had bull markets. We had recessions, and that's the time period that I would use. because as you can see, like small cap value, they've been punished for like 15 years. So how do we justify that? Is this like the elastic band is really, it's just the rubber band is really stretched right now. So then the correlation you kept it for past 12 years or so, I mean, like 2010, and you kept buying small value. How about gold? I mean, gold from 1980s to 2002, and silver, it went nowhere. So if you had it in your portfolio, how would you justify? But then look what happened. We bought gold from a portfolio in 2002 at $250. Do you think the clients are happy right now? So that's what the diversification also comes into picture. So the rule number one, whatever year that you use, Richard, generally asset classes, they keep their correlation, whether it's gold and dollar in 1980s or today. Generally, they do. So you want to look at the big picture and not emphasize a lot with like 5 or 10 years. So that's how I start with the big picture, and then we can go with the individual assets. So I hope that's helpful. But
That's helpful. Thank you.
sure, you're welcome. Anyone else? Was this helpful? Especially, sometimes that is like a new experience for us. Okay. If not, then I really appreciate it. I hope, again, I'm not overwhelming you with a lot of videos, but we will continue. So we haven't done any analysis of stocks, so we will get into that, talk about screening, finding, valuable stocks or, candidates and how to analyze them, different industry. We look at that. And also we'll look at, again, successful trading business for some of our traders. So, okay. If there's no more question, I wish you a wonderful weekend. And if you're in Canada, enjoy that beautiful weather. And good luck, Richard. Tomorrow we'll be thinking of you. It's a great
Thank you.
cause, and we'll see you next week. Thank you so much, everyone. Bye for now.
See you next week, Ruben. Thank you.
Thank you. Bye.
Thank you, Uncle.
Bye, Ken. Bye,
Thanks,
Kenneth.
Ramin.
Okay.
You're
Thank you, Ramin. See you next week.
Bye, Chano. Bye, Jackson.
Thank you.
Thank you, Lisa. Have a great weekend.
Thank you.
Yeah, you too.
Bye. Stop sharing. All right.